Today, the ups and downs of future rates, the DFA daily to the 23rd of February 2021. Again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and property news with a distinctively Australian flavour. And just a quick reminder, tonight at 8 p.m. Sydney time, I'll be streaming my live show and I'll have Adam Stokes on, and we'll be discussing the digital economy, Bitcoin and other cryptos, and get a sense of what may be happening in the months and years ahead. So join us for a live discussion. And of course, you can always send a question through ahead of time or join the live chat. Westpac has forecast that house prices across Australia will grow over the next 2 years, driven by, quote, broad momentum, supported by monetary conditions and the economy. Matthew Hassan, senior economist at Westpac, said that the bank is projecting price growth to be more like 10% this year nationally. That compares to 4% when we first put a forecast out back in September, he said. Additionally, a further 10% gain is in prospect for 2022. In the latest Housing Pulse report, Westpac noted that Australia's economic outlook has continued to improve. The threat from the end of temporary loan deferrals has diminished, and the RBA is committed to maintaining highly stimulatory monetary policy for several years. The rebound in the second half of 2020 looks to have been stronger, they said, with GDP now estimated to have contracted just 2% over the year, compared with 3.5% decline that was expected in their previous report. Growth is now forecast at 4% in 2021, compared with 2.8% just 3 months ago. And the bank warned that there are still questions around the extent to which investor activity lifts and the impact of weak migration inflows. However, they said both may be bigger issues for the market's next correction phase rather than the current upswing. The bottom line is that the upswing has strong, broad momentum that looks to be lifting further and will remain well supported by monetary conditions and the economy, and that points to price growth running at 10% in 2021 and 2022. And of course, the term funding facility, which provides 3-year funding for banks and other financial institutions at just 0.1%, is still to be fully drawn down, with around $100 billion available until June. And whilst it's then set to expire, it's very likely that it will be maintained in case there are any further disruptions to credit supply. But actually beyond that, they still believe that rates will remain low. However, Bloomberg reported central banks are already facing up to the threat of rising bond yields. Reflation trades reached a fever pitch in Australia's bond market on Monday in a burst of activity that will be hard for global policymakers to ignore, they said. 10-year yields climbed the most since the height of the market dislocation in March 2020, while benchmark 3-year yields inched further above the Reserve Bank of Australia's 0.1% target. And this was after the RBA ended a 2-month hiatus by stepping back into the market to purchase $1 billion of Australian short-dated debt. The moves underscores the challenge to central banks as they strive to keep borrowing costs low for years to come, while investors position for a more immediate return of inflation. Global vaccination programs and talk of another commodity supercycle have all put Australia at the forefront of bets for rebounding growth and rising prices, making the RBA's job particularly difficult, they said, but it's unlikely to be unique. Commodity prices are showing us a clear reflationary environment, said Chris Rands, a portfolio manager at Nicker Asset Management in Sydney. This is all about a global reflation story. The flow of positive vaccine news is saying that this isn't crazy. Climbing yields are a challenge to central banks such as the RBA, and expectations of more economic stimulus from the Biden administration and positive signs on containing COVID-19 are pushing rates higher globally, with the US benchmark 10-year yield hitting a one-year high of 1.39% in Asia trading. And Australia's 3-year yield edged up to 0.13% on Monday, while the 10-year yield jumped 17 basis points to 1.6%, a level last seen on March the 19th, but excluding that day, it's the highest 10-year yield that's been around since mid-2019. While the central bank has signalled that rates won't begin rising for at least 3 years, money markets are now pricing in about a 30% chance of a hike by mid-next year. It's entirely reasonable for markets to start pricing in some risk of the RBA hiking rates, said a senior rates strategist at TD Securities in Singapore. Markets are going to price in increasingly higher odds of the RBA having to pull the trigger before their 3 years are up. And there's a global dimension to this too, because Europe has also been caught up in the bonds sell-off, with German 10-year yields, the region's benchmark, climbing to the highest level since mid-2020. As the euro area's yields track those on treasuries higher, it faces an undesirable tightening of monetary conditions, according to Eric Nielsen, Group Chief Economist at UniCredit SPA. If they continue to climb in coming weeks, it'll leave the ECB no choice but to step up their purchases, Nielsen wrote in an investor note last Sunday. I would be surprised if we don't hear the first warning shots from key members within the next couple of weeks. Some Fed officials, though, are willing to accept the rising yield as a sign of optimism in the recovery. That's the view of Federal Reserve Bank of New York President John Williams, as he explained in an interview with CNBC last Friday. And Australia's policymakers may yet disappoint rate traders preparing for a shift. The central banks fear that the bond market is jumping to what will be a transitory hike in inflation over the months ahead, said Shane Oliver, chief economist at AMP Capital Investors in Sydney. They would rather look through any short-term spike in inflation and allow the recovery to use up spare capacity and generate higher wages growth before tightening. And this may still be several years away. And in the light of these rate moves, National Australia Bank announced cuts to several fixed home loan rates after seeing post-Christmas demand in the housing market pick up much more quickly than usual, they said. The major bank's 5-year choice package fixed rate for owner-occupiers paying principal and interest saw the biggest cut, with NAB slashing it by 55 basis points to 2.24%. Meanwhile, the 3-year fixed-rate owner-occupier loan was lowered by 11 basis points to 1.98%. And for investors, NAB's lowest rate is 2.44% for both a 2- and 3-year fixed-rate loan. Rates remain historic lows, and at NAB we're excited to offer even lower rates to our customers across most of our fixed rate terms, said Andy Kerr, executive home ownership at NAB. Both our 3- and 4-year fixed rates for owner-occupiers paying principal interest are now below 2%, a level that would have seemed unbelievable just a few years ago. These changes will also offer our lowest ever rate. And Kerr added that NAB home lending applications in January were the strongest in 5 years. We're seeing very strong demand in the housing market, with activity post-Christmas picking up much more quickly than usual, said Kerr. This has come despite the ongoing challenges presented through the pandemic. For the past few months, home lending applications have been at their highest level in several years as buyers flock back into the market after a quiet period through the nationwide lockdowns. We expect the current trends to continue in the near term, given the historic low rates and government support programs. Meanwhile, Steve Mickenbecker, Chief Group Executive Financial Services at comparison site CanStar, said the rate cuts show that NAB is competing for new business by taking advantage of low-cost funding. Interest rates continue on their downward path for homeowners and investors, he said. Low-cost funding has made fixed rates the playground for the big banks, and while the Reserve Bank term funding facility remains available, the great deals should stay strong. Yet, National Australia Bank's ratio of troubled loans climbed to a 7-year high in January, largely driven by mortgage borrowers falling behind after the expiration of COVID-19 related repayment deferrals. Impaired assets, which consist of defaulted exposures and loans in arrears by 90 days or more, accounted for 1.18% of gross loans and advances in January, according to a recent report. That's up 17 basis points from the end of December and higher than the prior peak of 1.06%. However, NAB said that asset quality trends for these customers, while worse than the total portfolio, were better than expected, and there was some market worries of rapid deterioration in mortgage arrears because NAB restricted deferral extensions to a small part of its book, according to a recent report from the Australian. Even with the spike, more than 90% loan deferrals by value have resumed repayments, NAB reported. And on Monday, the Bank of Queensland confirmed that it had entered into an agreement to acquire 100% of Members Equity Bank Limited, or ME Bank, for $1.325 billion. Under the proposed deal, which is expected to be completed at the middle of this year, subject of course to regulatory approvals, the ME Bank name and offering would continue as a separate brand. That would mean that the Bank of Queensland Group would consist of 3 brands: Bank of Queensland, ME Bank and Virgin Money. The addition of ME Bank is expected to broadly double the size of the retail bank, increase retail earnings contribution from around 36% to more than 50%, and balance out their East Coast presence. The increase in customer numbers means Bank of Queensland Group can now provide a genuine banking alternative to around 1.45 million people. Currently, approximately a third of Bank of Queensland's loans are originated via brokers, while 75% of ME banks are written by brokers, and nearly all of Virgin Money's come via that third party. As such, the MD and CEO of Bank of Queensland, George Fraser, told the advisor that the broker channel was extremely important to the group. Speaking to the advisor following the announcement, Fraser said, "We will be expanding our accreditation with brokers. If anything, it's a channel we love, it's a channel we really support, and it's extremely important to all of our 3 brands." And he later says, if you think about what's going to really drive our growth going forward, it will be to continue to provide an amazing service to our third-party brokers and aggregators. And the CEO then added it was really important for the group to help more Australians into their homes, adding that the 3 brands provide different segments in the Australian economy choice around that. He said, if we think about how we actually approach them, these different segments have different needs. So effectively at Bank of Queensland, it does require more of a personal touch. And that's why we have our owner-manager branches, which is really important. But we also distribute through brokers, and that's going well. Virgin Money is purely broker at this stage, and as you know, ME is primarily through the broker channel. That importance will continue. However, Fraser did say the group hadn't yet tapped into the digital channel, revealing that Virgin Money will next month launch a direct mortgage offering on the new Temenos platform, as the bank continues to reposition itself as a digital bank. Fraser said the new digital offering would be available via a state-of-the-art new mobile banking app, which would enable the group to then provide services through a digital channel to all of its customer segments. That's going to form the core banking platform for the whole retail bank. It's built to be multi-brand, so over time that's another channel we can provide to each of those customers that choose to bank with either ME Bank or Virgin Money. So we're very excited by that, he said. Now, over in New Zealand, the official cash rate could start to rise as early as next year, according to a leading bank economist. On Wednesday, the New Zealand Reserve Bank will deliver its first monetary policy statement for 2021. It will review the official cash rate, which is, of course, a tool used to keep inflation under control. Following a 75 basis point drop in March in response to the COVID-19 pandemic, the OCR has stayed at 0.25% for about 12 months. But according to ASB's quarterly economic forecast, which was released on Monday, the OCR could now start its upward descent as soon as August 2022. That's a year earlier than it forecast just a few months ago. And they said that some first home buyers might miss out because of the mortgage backlog ahead of LVR restrictions coming in March. And heading further into 2021, ASB Chief Economist Nick Tuffley expects a rise in construction activity to deliver a significant boost to the economy, following the 14% jump in gross domestic product in the September 2020 quarter. GDP is forecast to finish the December 21 quarter 0.7% up on the same time last year. And inflation is nearing 2%, supporting employment, with unemployment around 4.69%, and that was previously expected to peak at around 6%, but now it's likely the peak has passed. The key difference between our outlook now compared with a few months ago is it looks like inflation is getting up around the 2% mark and staying there later this year, Tuffley explained. The RBNZ's traditional weapon of choice, the OCR, is likely to remain at 0.25% into next year before it gradually lifts back from its emergency settings. By early 2024, the bank expects the OCR to be around 1.25%. We're just getting further along our recovery so much quicker, and it means the need to keep putting the foot flat to the floor will gradually abate, he said. This year, closed borders and weaker global growth are still likely to impact local economic performance, including exports. The availability of the COVID-19 vaccine, administered to the first group of Kiwis on February the 19th, has bolstered confidence, triggering a global share market boom. But there are still risks around production delays and COVID-19 mutations reducing its effectiveness. In our view, it will be some time during 2022 before the New Zealand global economy properly enters recovery mode, and that will then allow for above-average rates for GDP growth, he said. Although ASB has seen slight increases to wholesale interest rates in the short term, Tuffley expects Reserve Bank large-scale asset purchases and funding for lending programs to keep interest rates low. At the moment, we're at or near the lows of retail interest rates. Over time, interest rates, particularly term interest rates, are expected to gradually start grinding a bit higher, he said. But Kiwibank's senior economist Jared Kerr and Infometrics senior economist Brad Olson also expect the OCR to remain unchanged on Wednesday. Before increasing the OCR, the Reserve Bank is likely to wait for sustained rises in inflation, employment and business investment. The Kiwi economy has performed remarkably well, and there's plenty of monetary and fiscal stimulus driving growth and lifting confidence. Kerr said the RBNZ will remove the optionality around further rate cuts and revise the economic forecasts higher, he added. And Infometrics currently expects the OCR to remain at 0.25% until 2024. The Reserve Bank is expected to note the stronger performance of the labour market and higher than expected inflation, but also sound caution over the pathway ahead and desire to see a higher trend for inflation and employment before any moves to change interest rate settings, Olson said. And the point I want to make is that if you put all of those stories together, you can see that there is a lot of uncertainty about rates going up, rates going down, inflation going up, inflation going down. And the level of uncertainty here is probably as significant as I've ever seen it. So I think we should be cautious about making decisions at the moment because there is massive uncertainty. And of course, with uncertainty comes risk. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.